Hello everyone and Happy New Year! Markets are entering the year with strong momentum, building on a very good performance in 2025. Let's take a quick look back at last year to set the stage for what's ahead in 2026. 2025 was an excellent year for US equities. The S&P 500 rose by 18%, following gains of around 25% in both 2023 and 2024. This marked the third consecutive year of a strong bull market in the US, with positive momentum also visible across global equity markets. As a result, the market set 39 new all-time highs over the course of the year, and it also has reached additional record level this year. Notably, the S&P ended the year higher for 8 consecutive months, a streak not seen since late 2017. Markets are therefore entering the new year in a strong position, supported by the historically favorable seasonality of January. Because normally early in the year, capital typically flows back into the market, investors are rebuilding their positions, and the current volatility is low, even as the calendar fills with potential market catalysts. If companies in the S&P 500 deliver positive year-over-year earnings growth in the fourth quarter of 2025, with results reported in January and February, this would mark the 10th consecutive quarter of earnings growth. Such a trend provides a solid fundamental foundation as new capital allocations begin to take effect at the start of the year. Healthy economic and revenue growth, continued profit strength among the largest US companies, and an emerging productivity boost from AI adoption are expected to lift S&P 500 earnings per share by around 11% in 2026, providing a strong foundation for a continued bull market. As the chart shows, earnings momentum is spreading beyond a small group of mega-cap leaders. Technology stocks are still set to outperform, but there is significant potential for growth to broaden. We are already seeing earnings gains picking up in other sectors such as industrials, energy, and financials, which reduces reliance on a single group of companies to drive overall index growth. But the valuations are high, clients say. That's the common pushback, and frankly speaking, that's true. The forward price to earnings of the S&P 500 is currently historically high at 21.8. But we observe that the forward price to earnings was even higher than it is now on September 2020, just 5 months after the end of the pandemic lockdown. It was over 23 back then. Yet, the S&P 500 has nearly doubled since then, and that's despite a painful bear market in 2022. So valuations are very important and really a backbone of every investment process, but they are not the best market timing tool. The chart shows that since 2009, US firms had best earnings, and this was rewarded by best performance. That's all for today. Next time, we will take a closer look at some of the key risks for 2026. As we enter the fourth year of this expansion, higher volatility and stronger pullbacks could actually present opportunities to add risk to your portfolios. Stay tuned. Cheers.